Hello, everybody. Welcome to Public Live. I'm your host, Nora Ali. What a year it's been for the world of cryptocurrencies. Just for some context, Bitcoin is down nearly 40% year to date, Ethereum down nearly 50%, but there is one genre of cryptocurrencies that is intended to be stable, and that is stablecoins, which are pegged to government-issued currencies like the US dollar. And one company that operates in this space is called Circle. The company has intended for USD coin or USDC to be, quote, the most transparent and trusted dollar digital currency. And those are the words of our guest, Jeremy Fox-Jean, who is the CFO of Circle. So Jeremy, with that, I'd love to welcome you to Public Live.
Nora, thank you for that. Thank you for that welcome. I'm thrilled to be here.
Awesome. So Jeremy, Circle's CEO, Jeremy Allaire, had said in a CNBC interview that the internet needs native forms of digital currency. In other words, how do you take the price stability of the dollar and give it attributes of cryptocurrency, like global reach, nearly instant settlement, and cheap and secure transactions? Can you explain further why stablecoins are necessary and how Circle fits into all of this?
I can. The real issue here is sort of internet native digital currency and what actually that means. And I divide it into two elements. The first is the stable piece and the second is the internet native piece. The stable piece is relatively straightforward. We exist, and by we, I mean the vast majority of humans. We exist in a world that is structured in countries, that is governed by laws, that is governed by regulations, that is driven by our cultures. We, or at least I, in the United States of America, I pay my bills in US dollars, I get paid in US dollars, and I think in US dollars. And so anything that I do, or anything that a typical business would do in the United States, we're going to be thinking about wanting to use dollars, which is why native cryptocurrencies, like Bitcoin, for example, don't make great means of exchange because they're not price stable. Price stable versus the dollar in this case. They fluctuate, whereas I'm thinking about, $3 for a cup of coffee. Then the second piece of that is internet native. The US dollar as it exists today doesn't exist as a native asset in the open internet. We can, sure, using many services, send money from one counterparty to another. Businesses can send money from one to another. But this isn't internet native, not in the way that there are data types existing in public internet infrastructure, not in the way that we can email in a permissionless instant way, for example, anyone, anywhere. So we need to have some form of native internet data type that represents the money that we all know and use. That's where stablecoins come in.
Very clear explanation. Thank you for that. Just taking one step back then, how does a stablecoin remain stable in theory?
Well, I think there's really, and the markets have shown this, there's really two ways that can happen. The first, and this is the way that our stablecoin USDC operates, is that it's fully backed with those assets. So USDC, for example, is and has always been fully backed by the equivalent value of US dollar denominated assets. And that reserve, the USDC reserve, is held entirely in cash and short duration US government obligations. In this case, all US dollar treasuries with 3-month maturities or less. And so essentially when you hold a US dollar coin, you know that that USDC is always redeemable 1-for-1 for a US dollar. Now, USDC is a native data type that exists in the internet, so you can, using any one of 8 blockchains currently, effectively transact with that at the speed of the internet, with all of the superpowers of the internet, if you like. Now, the other way, because your question was how can a stablecoin remain stable, that is one way, fully backed by the assets that it purports to represent, and then preferably regulated. There is a third party or several third parties providing layers of assurance for consumers, protection for consumers. That's what regulators do. They provide protection for consumers to ensure that the stablecoin issuer is actually doing what they say they are doing. Now, the second way I think we've seen stablecoins work is sort of an over-collateralized stablecoin. And DAI, the stablecoin of the MakerDAO protocol, is probably the best example of this. It's certainly, I think, the longest running example of this. And that is to create, let's say, a $1 stablecoin. You deposit collateral significantly in excess of the value of the stablecoin that you're creating. So you put up $100 of collateral and mint perhaps $50 of stablecoin. And if the price of that collateral starts to fall, you then liquidate it. So you've liquidated it all before you get to the amount of stablecoin. And that way it's also remains stable. And that's the second way. Others have tried to invent other ways. The markets have talked a lot about algorithmic stablecoins, but so far none of those have stood the test of time.
Okay, you brought up algorithmic stablecoins. We'll get into that. One important thing that you referenced is that Circle customers can always mint or redeem USDC in one-to-one exchange for US dollars, and that's not the case for Terra USD, for example. That is an algorithmic stablecoin that decoupled from its $1 peg. Its sister token Luna crashed as well. Give us maybe the basics of how an algorithmic stablecoin is different from USDC and what went wrong in the case of Terra Luna.
There's a lot in that question. A lot of people, as you know, and as we all know, have been focusing greatly on this over the last week since the collapse of the Luna Terra ecosystem. Winding it back a little bit, the Terra Luna ecosystem purported to create a stablecoin, UST, in a reflexive and algorithmic relationship with the underlying token of the Terra blockchain, which was the Luna token. And the relationship was established by a mint burn algorithm, which said you could always take one USDT and exchange it for $1 of Luna, whatever the trading price of USDT was. And you could always take $1 of Luna and create UST vice versa. Now, what that did, it set up, because of that algorithmic relationship, it set up a set of incentives for market makers, participants in the capital markets, to ensure that that peg was maintained. Because if in trading the peg slipped, the theory was that a market maker could always then buy the token that had slipped from the price peg, swap it for the other, make a profit, and that would maintain the peg mechanism. So even when we talk about, or the market talks about, algorithmic stablecoins, it's actually relying on the entire market set of participants to maintain that peg. So in terms of, it's very decentralized in that way, but it does rely on humans and human profit-making ambition to secure that peg.
Do you think the Terra team acted irresponsibly in any way? How do you think they should have handled this situation?
Well, it's not my position to comment on sort of the actions of a protocol's founders and the many participants. What's very clear is there was a very large ecosystem around Terra, and what's very, very clear is the collapse of this stablecoin, wiped out $50 billion thereabouts of value, and that has a huge human impact. And at the same time, we probably lost 800 billion from the crypto total market capitalization, which obviously impacts even more people. And to keep this in perspective, we've probably lost I don't know this number, it's got to be something like $8 trillion from the equity market capitalization over the last months as we've seen the fall in tech stocks.
Mm-hmm. Yeah, I mean, this has all raised the eyebrows once again of regulators. Treasury Secretary Janet Yellen had renewed calls for Congress to pass legislation to govern stablecoins in light of Terra's depegging. The SEC chairman has called out stablecoins in the past as well. In your eyes, do stablecoins need more regulation, or is this sort of specific to the algorithmic stablecoin world, the world of Terra Luna?
Well, I think that anything in the world of financial services, when it gets to be a sufficient scale and when it touches very many consumers, needs good regulation. Right? That's the bedrock upon which all of our financial services infrastructure is built. And so that's fundamental point number one. Regulation is good here. Second point I'd make to our listeners here is that many stablecoins today are regulated. USDC, or rather Circle, the issuer of USDC, for example, is a regulated financial services company within the United States. And so we are already subject to oversight, we're subject to examination, and our actions are governed in many ways by a regulator. Our view, though, is that stablecoins at this level of scale deserve federal level regulatory oversight. And that really falls into three buckets. You can have stablecoins treated like securities, in which case they would fall under the regulatory purview of the SEC and Chair Gensler. You have stablecoins and stablecoin issuers treated like banking infrastructure, in which case they would fall under the regulatory oversight of the OCC, the Office of the Comptroller of the Currency. Or they could be treated as some form of commodity, and they would fall under commodities regulation. And those who follow kind of the politics and the regulatory agencies of crypto markets closely will see that there's a bit of jostling going on. Let's call it good-natured competition between those three regulatory agencies as to who should regulate stablecoins and crypto assets more broadly. But I think it's safe to say that good regulation is a good thing so that well-acting organizations can firstly ensure that they do the right thing, but more importantly, provide assurance to everyone else, provide assurance to all market participants that people are doing what they say they do.
Of those options, what makes the most sense to you? Getting treated like securities or banking infrastructure or commodities? What would be your choice essentially?
Well, I'd start by saying that I'm open and we're open to sort of whatever our elected politicians and legislative leaders so decide. We trust they will run an open and fair and thoughtful process where they will consult broadly with the industry and form something that ends up working for all market participants. But with that said, a few other comments. I think it's pretty clear that if you were to treat a stablecoin like a security, that would be challenging for the crypto industry and the stablecoin industry. Securities need to be bought and sold under a certain type of consumer protection, and that protection exists to ensure full disclosure of the risks related to high-risk assets. I think it's pretty clear when we talk about a stablecoin that's run well, certainly one that's fully backed with cash and short duration government obligations, that is not at all a high risk asset and therefore does not naturally fall. It's certainly not an equity risk asset, and therefore it doesn't naturally fall into the classification of security. So I think stablecoin looks much more like a commodity or banking.
And as you mentioned, Circle is a regulated financial services company. So when you're looking at your users, what actions is Circle taking to improve transparency and security in response to the Terra collapse for those users and buyers who might be a little bit nervous now about the ecosystem?
Well, we have always been committed to transparency, and we have, since the launch of USDC, and this is why it was launched the way it was launched, it has always been designed as a 100% fully reserved stablecoin. Its entire design center is around being exactly that: regulated, transparent, and therefore able to be trusted. So it's always been clear what the USDC reserve is invested in. And every month since launch in September 2018, we have published to provide third-party assurance over that statement. We have published attestations from one of the leading global accounting firms that the reserve is indeed what we say it is. So your question was around what actions are we taking now? And I'd reframe it and say we have always taken those actions.
On a very high level, what do you make of what's happened with Bitcoin, Ether, and other cryptocurrencies in the recent fall in value?
There's a lot of, we all know that Bitcoin has gone up and down significantly several times in its history. There's a lot written about kind of volatility of crypto assets. That's a fact. It's unclear to me whether it's a good or a bad thing. Many tech stocks are down 70% in this market correction. So I don't think we should be looking at Bitcoin and crypto assets as different from many other innovation forward assets that people can invest in. Obviously, anything falling 70% is damaging and difficult for the holders of those assets, certainly if they invested into those assets anywhere near the top, and sort of we all feel that and feel for all of those individuals. We think though that in the long term, divorcing ourselves from the noise of market cycles, in the long term, the future is bright.
That's something to remember. In the long term, the future is bright. So I guess relatedly, for those retail investors who lost a significant amount of money given recent volatility and downturns, what are some of the lessons for the crypto community? What should our listeners be taking away? Or is it just that, that long-term view that you alluded to?
I think the biggest lessons are relatively timeless, and they're timeless for all investors, and they're sort of common sense lessons. The first is, never is keep your house in order. Never invest more than you can afford. Never invest more than if you lost it. It's sort of in any one particular stock, right? If you lost it, then it would hurt you more, and you wouldn't be able to sleep at night. That's the most fundamental thing. Don't put all of your chips, as it were, on any one bet. That's the most important thing. Then the second thing is sort of know why you're investing. Don't invest just because other people say something is a good idea. Really take the time and the thinking to understand. Again, I'll go back to that long-term theme. What is the long-term view that you are taking? Fundamentally, it's all about don't follow the fads and do your own research.
Don't follow the fads and do your own research. Very great advice. So speaking of long-term, what is the long-term plan for Circle in terms of helping to scale the blockchain and crypto ecosystem or otherwise? What's on tap for the company?
So the first thing I'd say is we think the long-term opportunity is enormous. Stablecoins, which I think reached a peak of 200 billion in circulation. Stablecoins are going to be at the heart of this new financial system that we are building, and bring it up a level. That there's a macro shift here, which is the impact of blockchain technology on financial services is going to be as great, if not greater, than the impact of the internet on the media, communication, information industries. Now, I'm nearly 50 years old, and that's been one of the defining themes of my career, if not my life, as we have driven the cost of communication down to zero, where video chat, for example, is now a commodity-free service on the internet. And as we drove the cost of that communication to zero, the amount of communication exploded. And we invented all sorts of new things to deal with this new information and communication, whether it's Facebook or Google or any of these other things. This is happening. It's just starting to happen in financial services. And stablecoins are going to be at the heart of that transformation, which we will see play out over the next 3, 5, 7, 10 years. We hope that Circle is going to be at the heart of that transformation. And there's a bright future ahead, and a very, very long kind of pathway of growth. In the immediate term, some of your listeners may know that we are planning on going public, hopefully by the end of this year, as part of a merger with a special purpose acquisition company. But we're planning to go public by the end of this year and to be a listed company on the New York Stock Exchange, which, again, back to my points earlier about transparency and trust, only elevates the scrutiny upon us and only elevates the regulatory oversight of our company and of the products and services that we offer.
All right. Well, Jeremy, on that note, we will leave things there. That was enlightening, and I certainly understand this ecosystem better than when we started. So, Jeremy, thanks again for the time.
Nora, thank you very much. A pleasure to be here, and thank you to everyone for listening.
Yes, thank you very much to everyone, and we will catch you next time. Thanks to our listeners.
If you would like to see more content like this, subscribe to our channel and download the public app where you can listen to these sessions in live time.